Hey guys, Dave Keller here with Market Misbehavior. I love to ask interviewees what their one chart would be, and that is if you had one chart, just one chart, as a way to break down or understand the market environment besides just a regular chart of the S&P 500, what would it be and why? Today, my one chart is the ratio of the financial sector versus the technology sector. So my overall approach to market analysis is to go through price, breadth, and sentiment. That's how I think of the big picture market environment. And then I love to go through a series of ratios, and I have a whole chart list set up where I review key ratios, and it goes across themes, styles, sectors, regions, etc. So things like small cap versus large cap, US versus non-US, growth versus value, high beta versus low volatility. There's a whole series of ratio charts that I review regularly. And what this does is it helps you answer that very important question, which is how does security A or ETF A compare to this other thing, right? How do these two things relate? And by analyzing the individual charts and then thinking about the ratios as well, you really get a good sense not just of how one particular stock or sector or group is doing, but how that relates to all the other levers you could pull as an investor on any given point. So I think what we'll do today is look at some of the long-term ratios, how some of these have evolved, in particular, the rotation away from the growth-oriented technology sector into more of the value-oriented financial sector and what that might mean for you. Before we get there, though, I'd love to remind you, if this sort of thinking about investor behavior, decision-making, visually analyzing the markets, looking at investor psychology, trends, and momentum, I hope you'll hit subscribe. Just click on the button on the video. Also, I'd love if you give this video a like, put a comment below the video and tell me what you think in terms of financials versus technology. Which of those two sectors do you think is set up best for the next 2 to 3 months and why? Let's get to the chart. All right, so here we're looking at the long-term ratio of the financial sector, the XLF, versus the XLK, the technology sector. And this is looking back over the last 3 years. So we're going back starting at the beginning or first quarter of 2018. You can see overall, for much of this chart, it's going down and to the right as technology is that sector and the growth-oriented space of tech has been outperforming financials, or put another way, the financial sector, the value-oriented space of financials have been underperforming. There's a number of reasons why this has been the case. You've had interest rates continue to go down. You've had bond markets in a cyclical uptrend, arguably a secular uptrend for quite a while. Rates have remained relatively low. That's not a great environment for financials, and recent years have been all about the FANG stocks or the FANG trade, dominated by tech, consumer, discretionary, and communication services. But look at how this has changed. If you think about the chart of the S&P 500, which peaked in September, had another secondary peak in October before it broke to new highs. Look at how there's a change of character in this chart, really in a consistent downtrend through the beginning of September of last year. And then that's the bottom. Look at how it's rotated back higher, back above its 200-day moving average for the first time since January of 2019. Since then, it's been a pretty decent pattern of higher highs and higher lows as the financial sector has continued to outperform. Back here in the third to fourth quarter, this is when we started to think about financials and energy really starting to appreciate after being, just the dog sectors. I mean, just avoidable sectors because of weak relative strength. Look at how they've started to improve on a price basis, on a relative basis. But when you look at this ratio, you can see this general rotation from a growth-oriented market to a value-oriented market. Now, this ratio looks very similar to other ratios you could do that express a lot of the same analysis. For example, we could look at a similar chart of growth versus value. The ratio essentially looks very, very similar. You can see the downtrend in the ratio until September and see how that's turned up. And again, a lot of that is because of financials and really energy outperforming things like technology. You can even look at individual stocks. So if you look at the ratio of JP Morgan to something like Apple or Microsoft, you're going to see the ratio a little different, but overall looking very, very similar. So when we think about what the market is doing now and how the S&P is pulling off a little bit, how technology, especially the FANG stocks, have been sort of faltering, sort of range bound, more at the lower end of the range, while banks and others have been rallying. This really has been the story of the last 5 to 6 months. It's not a new phenomenon to see financials outperforming. They've actually been a much better bet than technology stocks for the last 6 months, right? Since the September market peak. So that was really when we had a change of character between the two. So what does this mean? Well, this ratio going higher, you're assuming a lot of things. You're assuming a continued rotation away from the growth trade, continuing to move into more of the value-oriented space like financials. You're assuming that interest rates are going to continue to appreciate or remain more elevated than what they've been recently, which allows financials sort of a tailwind to the performance of the financial sector. You're assuming a yield curve that will remain steepening, that will continue to steepen, because that's what, overall tends to help financial stocks versus other sectors. So you're making a big assumption when you're thinking that this ratio would go higher, that there'll be continued strength in financials driven by interest rates, and also that technology stocks will continue to suffer. I don't think that's a bad assumption, a set of assumptions to make. And again, as a trend follower, I'm going to assume that trends will continue until proven otherwise. I think it's important to note that this is not just a quick up move. There have been a series of upswings as the ratio overall has been going lower. And it's been a month or two where you'll see a move higher before the next leg down. This is a more of an extended move. This is a longer upswing. This is a reversal of sorts, I think. You've seen higher lows in the ratio. You've seen now it's almost 6 months of this ratio transitioning from a downtrend to an uptrend. I think this has a little more staying power than some of the bounces we've seen in the ratio before. Now, before you get too excited that this is the beginning of a completely new regime, completely unwinding what's been happening before, if we back up this ratio about 20 years, you'll notice that this is just the, that move that I showed you, that incredible upswing, is just a rounding error on the last 20 years, right? The underperformance of financials really started around the financial crisis, right? That this ratio peaked in mid 2006. It was really before the market top, which was here in 2007. But well before that, you saw financials underperforming the technology sector, really accelerated 2007 to 2009. The low was there in the first quarter of 2009. This is when stocks bounced off of the 2009 lows, a V bottom really driven by financials. If you look at the chart of like Bank of America coming off of the lows, Citigroup and others, just incredible bounces. They really led out of the lows, but from there, they really tapered on a relative basis. And from then, you've been way better off owning technology versus most sectors, but especially relative to something like financials. So while this outperformance is compelling, and while I think certainly in the short to medium term, I think that ratio continues to go higher, financials have a long way to go to really represent that they are out of the woods and are a legitimate long-term outperformer relative to the technology sector. I would expect as this year sort of evolves, I think you see this ratio go higher. I think you see financials outperform to a point, but eventually people get back into the long-term technology trade, the growth trade. This evolution that we've seen into technology over time, I don't think is going away just because some of these growth stocks have gone too far too fast. I think this is a little more of a reset. That doesn't mean that this ratio can't go meaningfully higher, which I would expect it to do so. So that is our one chart for today, really looking at the ratio of the financial sector, the XLF, versus the technology sector, the XLK. This is one of the many ratios that I love to look at to understand the relationship between different sectors, styles, and themes. As I mentioned earlier, if this sort of thinking about investor behavior, charting, technical analysis, behavioral finance, and trend following is of interest to you, I hope you'll hit subscribe. Give this video a like, and at the bottom, again, put a quick comment in there. Let me know, which do you think between the financial sector and the technology sector, XLF or XLK, which do you think has better prospects for the next 2 to 3 months, and why? From everyone here at Market Misbehavior, I'm Dave Keller. Be safe. Talk to you again soon.